what we do realize is in December, the ECB included this new pledge that they want to keep financing conditions intact. If we look at the latest, and as mentioned before, the latest credit survey, we do actually see that credit to consumers, to the typical European consumers, is actually slowing down. So this puts into question whether financing conditions are still as favorable as the ECB wants them to be. So overall, we do think that more details on the ECB's reaction functions will be one of the main takeaways from today's meeting.
And Gero, looking at the economic data, Q4 came in largely in line with ECB expectations, but now, as we've entered Q1, the restrictions in place across Europe have been a lot more strict than people were anticipating as a result largely of the emergence of this new, more contagious variant. Do you think that the ECB has been too optimistic about the start of the year from an economic perspective?
What is quite telling, at least if we look at forecasts for this year, for instance, we do see that the ECB expects GDP for the Eurozone as a whole to increase by about 3.9%. Market expectations are actually higher than that. So it seems that overall, the ECB is quite prudent regarding the growth outlook. But in the very short term, what we do see is a couple of things. First of all, today, whether risks regarding growth are still tilted to the downside, this is very much likely, or whether this is even more emphasized, that risks have actually increased to the downside. This is one point. And the second point is tomorrow we get the flash estimate PMI readings for both manufacturing and services. And this will give shed some more light into the current economic situation at the beginning of the new year.
Tomorrow's data is going to be super important. We get, just a reminder for viewers, we're going to get the PMI flash numbers for January out of France, Germany, and the UK. So very, very important data point for investors ahead. I just want to go back to the ECB, and they keep talking about maintaining favorable financing conditions. And we know that they have expanded their balance sheets massively over the course of 2020. And yet, what can they do to stimulate demand? They can put all this cash out into the system, but they can't force banks to lend, and they can't force people to borrow. So what can they do?
So given the source of the problem with this pandemic, there's very little per se that monetary policy can do. But very concretely, what they can do, I mean, first of all, they already, as we all know, increased already their QE program in December, just six weeks ago. It takes some time to fall into place. This is one point. A second point is to really guide further market expectations. I mean, if we look at right now, the markets expect the ECB basically to keep a steady hand until September, which is 6 months before the possible end of the PEP program, which is March 2022, but to guide more market expectations that the ECB is ready to stand there and to do potentially more to favor favorable financing conditions. This is something quite important. On the other side, on the policy spectrum, I mean, the refi rate is already at zero. The deposit rate is already very much in negative territory at minus 0.5%. So we see little room there. We think that the strategic, from a strategic point of view, the ECB is likely to favor forward guidance.